Okay, hopefully, hi, good morning, everybody. I think we're gonna get started, guys. We're gonna try and get started. We're having a little tough technical difficulty here at the Buffalo Club this morning, unfortunately. Sorry about that. I wanted to welcome everybody. This is our first meeting of the year. For those of you who don't know me, my name is Leslie Kellogg. I'm a partner at Hodson Russ here in Buffalo. I'm a tax partner and thrilled to be president of the board this year. Wanted to also make you aware of who else is on our executive committee. Cheryl Jankowski from Lumsden, who's our presenters today. She is our vice president. Dan Biles-Smith is our treasurer, and Adam Holtz is our secretary. We are, there's some of us here in person, some of us via Zoom. That will be the plan to continue in that way for at least for the next couple of months. We've got programs in May and in June before we break for the summer. And certainly for May and June, we'll be both live in person and over Zoom for those who are not comfortable or can't make it in person. Just a couple other administrative reminders. About 50% of the membership has paid the dues, the annual dues of $110. If you are one of those, thank you very much. If you are one who has not, if you could take care of that as soon as possible. There was a dues notice that went out about a month ago, which you can look to. You can either pay by PayPal or just send in a good old-fashioned check, whichever you prefer. Let's see. Our next presentation is going to be May 19th, just so you can get it on your calendar. There'll be an invite going out soon. Because we're doing this via Zoom, we'll have an opportunity to have a presenter that will not be live and in person here, that'll still be in Burlington, Ontario. Laura Ball from BDO is going to co-present with me actually on owning vacation properties across the border and all of the various issues associated with that. So Canadians owning property here like in Hollymont or down in warmer climates, US folks with cottages up in Canada that currently can't get to them and are rather upset if they're like any of my clients or friends. So we'll be talking about that next time. And without further ado, I want to introduce our two presenters for today, which are Jenna Torella and Megan Morris, who are both managers at Lumsden McCormick. Jenna is a part of is on the audit side, and Megan's on the tax team, and they're going to update us today about the Paycheck Protection Program and some other things that everybody should be aware of. So without further ado, I'll hand it over to Jenna. Thanks.
All right. Thank you, Leslie, and thank you for having us today. As Leslie mentioned, we are going to go through the Paycheck Protection Program as well as some updates to the Employee Retention Credit. Both programs, as you are all aware, have been evolving, changing, and we're at about a year now that we've been dealing with the changes and keeping up with them. So we're just going to do a kind of where are we now, some PPP updates, go through the general PPP forgiveness process, and then look at both the 2020 and 2021 Employee Retention Credit, highlighting some of the differences between those programs, going through some of the special issues relating to the Employee Retention Credit, how to claim the credit, and then we'll leave some time if there are any questions. So where we are now, if we go back to December of 2020, President Trump signed the Consolidated Appropriations Act of 2021 on December 27th, 2020. This made second draw PPP loans available. It also expanded eligibility. So it increased the amount of, or the just industries that are eligible for PPP, as well as just the general size of entities that can apply. It extended ERC into Q2 of 2021, and it made PPP borrowers eligible for the Employee Retention Credit. So up until that point, you could only pick one or the other. So as of December 27th, you were now eligible to participate in both programs. And then a few months later, March 12th, 2021, President Biden signed the American Rescue Plan Act. That added $7.25 billion into PPP. It expanded nonprofit eligibility, and it also enabled PPP borrowers to now take part in the Shuttered Venue Operators Grant. So again, increasing the programs that are available to PPP borrowers, which was pretty limited when this all started. And it also extended ERC through Q4 2021. So now we're looking at Q2 2020 through Q4 2021 for potential eligibility if the eligibility criteria are met. So I am going to go through the Paycheck Protection Program, and then I will turn it over to Megan, who will handle employee retention credit. So current PPP status. Applications are available to be submitted through May 31st, 2021. This was recently extended from March 31st. And this is 100% dependent on the availability of funding. So this deadline could be not stopped, but if the funding is not available and all of the applications are in and the funding is used, we may not make it to May 31st unless there are additional funds added to the program. Going through some of the 2020 statistics, 521.2 billion in loans were approved in 2020, with about half of those either forgiven or under review. So about 209,000 have been forgiven to date, and about 84 billion is under review currently. That was about, I think that was the statistic as of last week, so there probably has been some more movement there. And then 2021 statistics, 232.8 billion have been approved in 2021. So that's under that PPP2 program. Another new update is Schedule C filers. So there is a completely separate standalone application for anyone that files a Schedule C. So their PPP amount is based on 2019 or 2020 Schedule C gross income. So taking Form 1040 Schedule C line 7, taking the monthly average of that. So dividing it by 12 and multiplying it by that factor of 2.5 that you're used to seeing in the normal PPP calculation. This is capped at $20,833, so that is the maximum loan someone can get without employees. So who is eligible for a second draw PPP loan? If you had previously received a first draw PPP loan and you can reasonably say that you will use or have used your entire amount of the proceeds, that does not mean that it has to be forgiven. It just means that you have to know that you have used it or you will use it in line with the spirit of the program. You have to have under 300 employees. If you have multiple locations, it's not more than 300 employees per location. And you have to experience a 25% drop in gross receipts in any quarter in 2020 compared to 2019. The SBA has released that gross receipts are all revenue in any form received or accrued. So this will be consistent with your accounting method that you typically use, and excludes any net capital gains or domestic and foreign affiliate receipts. So now moving on to just some of the general forgiveness rules. A minimum of 60% must be used for payroll. Again, this is a minimum. If you choose to use 70, 80, 90, even all of your proceeds for payroll, that is available to you. We have seen with the expansion for PPP borrowers that can elect to go for ERC, we've seen a little bit more non-payroll expenses being used just because you can't use those wages under both programs if they fall under the same time frame. But if you are not eligible, we have seen a lot of borrowers going for just payroll. It does reduce some of the documentation required to be submitted to the bank. And like I mentioned, be aware of expenses claimed under other funding sources. So if you have any grant funds that reimburse wages, if you've gone for ERC or you've paid wages under FFCRA, those cannot also be claimed under PPP. PPP forgiveness applications are due 10 months after the end of your covered period. After that, the lender has 60 days to issue their decision to the SBA, and then the SBA has 90 days from there to issue their final decision on forgiveness. Loans in excess of $2 million will be audited by the SBA in the future and also require a loan necessity questionnaire. This is really just some additional financial information to prove the necessity of the loan. You'll just have to gather some documentation. There's an option for a narrative to explain why you needed the loan. So just be aware that that is still in place. So PPP forgiveness covered period. This has changed a couple times. First it was 8 weeks, then it was 8 or 24, and now you can use any time frame in between 8 and 24 weeks. We've seen a lot of banks just kind of calculate the end of the forgiveness based on the date of the proceeds, but you can use, based on the guidance, any time in between the date you received the funds, which is the beginning of your covered period. So the day those funds hit your bank account is your first day. That really isn't flexible, but then you can go out anywhere in between 8 and 24 weeks. So if you've used your funds within 12 or 14 weeks and then you want to start claiming ERC from there, that is one way to have a clean cutoff of this is when my PPP wages ended, and going forward, I'm going to use the rest for ERC. So going through some of the eligible expenses for forgiveness, starting with payroll, and then we'll move into the non-payroll costs. So payroll costs are any costs paid or costs incurred during the covered period. So for example, if you have a loan that was deposited on May 5th, but you had a payroll that was paid on May 10th, but only a couple of those days fell under your covered period, you would still be eligible to claim that entire payroll period in your covered period because it did fall as paid in that period. Payroll costs include wages, which are salaries, wages, commissions, and similar compensation. And it excludes any employees with residency outside the United States. Wages also, payroll also includes employer portion of health, life, dental, disability, insurance, and 401k contributions, as well as employer, state, and local taxes. The cap for the 8-week period is $15,385 and $46,154 for the 24-week period. And that again is just the $100,000 equivalent of those 2 weeks. And again, we've said it a couple times now, we'll probably say it a few more times. This excludes grant funded wages, employee retention credit, or FFCRA wages. So just making sure you're not double dipping on the programs and making sure you're really separating out where your wages are claimed and making sure that they're not claimed in 2 places. So there are some specific rules for owner employees. So they are capped at $15,385 for 8 weeks, so similar to the standard employee calculation. The difference here is the 24-week period, which is capped at $28,333. It is limited to the 2.5-month equivalent of the 2019 compensation. One important thing to note here is that it does include health insurance and 401k contributions, so you will have to make sure you're separating that out on your employee versus owner employee calculations. And one of the things that we have seen the bank come back a lot with is the 2019 compensation, making sure that there's documentation submitted with the forgiveness application that would prove that amount out, just to make sure that they are capped at the correct amount for forgiveness. Looking at non-payroll costs, again, this is limited to 40% of the loan proceeds and includes business mortgage interest payments, making sure there's no prepayments claimed in the forgiveness application, rent or lease payments. With this, you're going to have to include all of your lease agreements and any invoices for the covered period, as well as the February 2020 invoice that would encompass 2/15/20. You can only include rent and lease payments and utilities that were established as of 2/15/20. So making sure you're also including that February 2020 invoice with your forgiveness application is very important. There are specific rules for related party rents. So any rent paid to a related party is limited to the mortgage interest paid during the covered period. Also in non-payroll costs are utilities, which include electric, gas, water, sewer, phone, which includes cell phone and business lines, internet, And then covered operational expenses included in here is software or cloud computing services, covered property damage. So this would be any expense that was not reimbursed by insurance for any of the public disturbances that happened during 2020, covered supplier costs, and covered PPE. So anything that you had to do to adapt to OSHA or CDC or Health and Human Services regulations to get your business up and running during the pandemic. The last thing we're going to go through is just some of the forgiveness applications. So what is available and who can use which application. So there's 3 options available right now: the 3508S, which is the most simple, the easy, which is a little bit easier but does require some calculation, and then the 3508, which is the full detailed forgiveness application. We'll go through each of them. So 3508S, this is, as I mentioned, the most simple application. It's really just a simplified checklist and certifications that the loan proceeds were used in this, within the spirit of the program. It is allowable only for loans under $150,000. So if you are above that, you cannot use this form. You have to note the amount spent on payroll and what your forgiveness amount is. And then there is no required documentation to be submitted with the application. There's definitely documentation that has to be maintained, but nothing has to be submitted with the application itself. If you are between 50 and 150,000, so when this all started, this application was only available for borrowers that had a loan of 50,000 or less. It was increased to 150,000 with some stipulations. If you are between 50 and 150, you still need to take into consideration any FTE reductions or salary reductions and reduce your forgiveness by that amount if it is applicable. But if you are under $50,000, you do not have to take into consideration any FTE reductions. Form 3508EZ, there are 2 qualifications that would allow a borrower to use this application. The first being that they did not reduce annual salary or hourly wages by more than 25%. So this is comparing Q1 2020 to the covered period. And then they also did not reduce the number of employees or average paid hours. So this is looking at January 1st, 2020 and the end of the covered period. The second qualification is that they did not reduce annual salary or hourly wages by more than 25%. So that's same as the first qualification. The difference here is that they could not operate at the same level of business due to regulations and mandates. Again, these are OSHA, CDC, Health and Human Services, federal or state regulations. And you're looking to compare that to 21520. The big thing here is making sure the documentation is there. So whether it is executive orders that you have printed or it's internal memos, board minutes, things of that nature, we just encourage that all of that documentation is maintained in your PPP file to ensure that if there are any questions that that is the qualification that you are claiming, that you have all of that documentation and can prove that you could not operate at the same level of business compared to 21520. So looking at 3508, so this is the full application, most detailed. It will require the most amount of calculations. We're just going to go through a couple of the big items, some of the calculations, the schedule. So starting with Schedule A, this is really where most of your information is coming from. It's your payroll schedules. It's broken into 2 different tables, so Table 1 and Table 2. Table 1 includes only new employees in 2020 or employees that did not make the equivalent of $100,000 in any pay period in 2019. And this is not an annualized rate, it is looking at single pay period. So it's determined looking at the highest pay period in 2019. So for a weekly payroll, that would be $1,923 per week. So if any pay period during 2019 exceeded that amount, they would end up moving themselves down to Table 2. So Table 2 is anyone that did not make over or did make over the limit of the $1,923 per week. The difference here is that they are not required to calculate a salary or wage reduction. And so just kind of within table or Schedule A, the tables, you'll have to disclose the name, an employee identifier. Typically, we see this either as the employee ID or the last four of the social security number of the employee, the cash compensation paid during the covered period, and then the average FTE. And then for table 1, you'll have the salary reduction. Table 2 will not have that based on the guidance. Then the last couple of things we're going to go through are just the salary and wage reduction and the FTE reduction. So starting with the salary and wage reduction, this is a dollar for dollar reduction of your forgiveness. So again, it only applies to protected employees, so those that are on table 1. And then it compares the average annual salary or hourly wage for 1/1/20 through 3/31/20 and comparing that to the covered period. It only applies if it is in excess of 25%. So anything lower than that, you do not have to take a reduction on. There is a safe harbor available, and that is if the wage rate is restored by February 15th or to the February 15th level by December 31st for PPP 1, or at the end of the covered period for PPP 2, there is no reduction to forgiveness. And the last thing on PPP that I'm going to cover is the FTE reduction. So FTEs for PPP are based on a 40-hour work week. Employees cannot exceed 1.0. So even if they work more than 40 hours a week, they are capped at 1. There is a simplified method available. So anyone that doesn't work 40 hours a week would be counted as a 0.5. We do recommend that this calculation be done both ways using the full and the simplified method. It does differ based on the mix of hourly and salaried employees. Sometimes one method works better than the other, so we do just recommend looking at both of those. And this does apply to all employees. So to determine the reduction, you're comparing the reference period, which can either be 2/15/19 to 6/30/19 or 1/1/20 to 2/29/20, and comparing that to the covered period. There are some exceptions that exist for anyone that was offered to be rehired or for their hours to be restored or any terminations for cause. So you will not take a hit on any of those exceptions. And there are also safe harbors available if you were unable to operate at the same level of business compared to 215. So similar to that EZ application qualification, or if FTEs were restored by 12/31 for PPP2, or at the end of the covered period for PPP1, or at the end of the covered period for PPP2. And this FTE reduction is applied to all eligible expenses. So if you have, let's make the math easy, $1 million loan, but had a 0.9 FTE reduction, so you reduced your FTEs by about 10% over the covered period, you would end up with eligible expenses of $900,000 for forgiveness. If your loan was only $800,000, you are still eligible for full forgiveness because you had enough expenses even with that reduction to get full forgiveness. So at this point, I'm going to turn it over to Megan for employee retention credit.
All right, so good morning, everybody. I'm going to now talk about employee retention credit, which is kind of the new kind of hot topic, even more so than PPP has been. So we're going to kind of go over what the credit looks like for 2020 and 2021. So there are a lot of rules that are similar between the 2 years, but there's also a lot of differences and kind of changes. And you'll find as we go through this that the 2021 credit is kind of more of the new hot topic, I guess, and it is a lot more powerful than 2020, but we are still seeing some people get a benefit from 2020 as well. So next slide. All right, so who is eligible for the employee retention credit? So in 2020, you're eligible if your business was partially or totally shut down in any quarter due to COVID-19 for 2020, or your gross receipts are less than 50% of the same gross receipts in that same quarter in 2019. So kind of once you qualify for this under the gross receipts test, you kind of automatically keep qualifying until your gross receipts are back to 80% of what they were for that same quarter in 2019. So that's a little bit confusing. In a couple slides, we're going to kind of go through an example of what that looks like and how you would determine your eligibility for 2020. In 2020, federal or state governments or any governmental agencies were not eligible employers for the employee retention credit. So kind of some more information on this slide. So basically these government orders had to kind of deal with, restrictions on an operation. So limiting commerce, travel, group meetings, those are the kind of executive orders here that would really sort of get you eligibility under this component for the employee retention credit. Gross receipts, it's a pretty expansive definition. So if you're not a tax exempt employer, it's any gross receipts that are under 448C. So this kind of includes your total sales, net of returns and allowances, any income received for services, income from investments, so things like interest and dividends, any income from like rents and royalties from outside services. Receipts don't include like anything collected for sales tax or repayment of a loan. And this is kind of determined on an aggregate basis. If you're a tax exempt employer, it's sort of similar where it's gross receipts, from all operations, not just UBIT. So this would include, sales, investment income, contributions, dues, and grants. Household employers are not eligible for the credit. And it's really important that you keep, documentation for how you're claiming eligibility for this credit. So whether that's keeping copies of those government orders, what exact dates your business was impacted by them, or, keeping that gross receipts data that supports eligibility just in case this is ever looked at by the IRS in the future. So moving on to kind of give a little bit clearer example for that gross receipts test. So you can see here the facts on the left side of the screen. So if in 2020 for Q1, we had $100,000 of gross receipts, but for that same quarter in 2019 Q1, we had $210,000 of gross receipts. We can see that obviously our gross receipts were only 48% of what they were in 2019. So that means we had a 52% drop and we're now eligible. Q2, we were back to 83% of 2019. And then by Q3, we were all the way back up to 92% of the same receipts that we had for that third quarter in 2019. So with this example, the employer is eligible beginning with Q1 2021. And then their eligibility would continue for Q2. But however, at the end of Q2, they're back above 80% of what their gross receipts were. So they're only eligible for Q1 and Q2 for the employee retention credit for 2020. And then if you didn't have any gross receipts or you weren't in operation for all of 2019, there's kind of specific rules for what quarters you need to reference and how you reference that. But we're kind of seeing most people, have been in business, but we're advising, specifically if there's situations where you weren't quite available, what comparison period you would use. All right, so once we determine if we're eligible, what's our maximum credit? So the credit's going to be equal in 2020 to 50% of your qualified wages. This includes any health plan expenses per employee up to $10,000 of wages for the entire year. And this for 2020, the eligibility is on any wages from March 13th, 2020 to December 31st, 2020. So March 12th, I believe, was the date where President Trump declared the pandemic a national disaster. So that's kind of where the date where that March 13th is sort of coming from, is it's basically every date after that. So since you are allowed, $10,000 of wages for the entire year, it allows you a maximum credit of $5,000 per employee. So if you were eligible for multiple quarters, but that employee makes on average, more than $40,000 a year, you're kind of going to eat up all of the credit that they're able to receive within one quarter in 2020. So kind of delving a little bit into those qualified wages. So what does that include? So it already includes your healthcare costs. In 2020, salary increases or bonuses are not qualified wages. So it kind of looks at the 30-day period sort of before you're eligible for ERC, and it's those, it kind of has to be wages based on a similar amount. You can't just bonus somebody $10,000 to take a $5,000 credit for them. You know, kind of as Jenna has mentioned, there's no double dipping among any of these programs. So if you get any grants, you have PPP, you know, the work opportunity tax credit, you took FFCRA or paid family leave, any of those wages that you're getting benefits for other programs for, you cannot also use for ERC. So no double dipping. And then in 2020, any self-employed earnings or wages are not eligible for the credit. So this part's a little bit confusing. So for 2020, it looks at a calculation restriction based on how many employees you had in 2019. So what this limitation comes into is if you had more than 100 full-time employees in 2019, which is based on a 30-hour per week average or 130 hours in a month, that's different from your PPP rules for what a full-time employee is. You can only take the credit for any employees who you are paying to not provide any services. So that doesn't mean they were working from home. It means that they were literally being paid to be outside of the office, not doing anything, if you have more than 100 full-time employees. And then any qualified wages that you claim could not kind of exceed what they were paid 30 days prior to when they were not performing the services. And we'll see, you know, in 2021, how this kind of restriction gets a lot more beneficial and opens up a lot more taxpayers to eligibility. But we're kind of seeing, at least with our client base, you know, we have a lot of clients that have more than 100 employees. So this, even if they might meet the other tests, it sort of limits them because not a lot of employers are going to pay employees to stay home and do nothing. Where some people are getting a benefit is if they decided to cover their health costs for those employees that they furloughed, they could still get a benefit for ERC based on those health costs that they covered for people that are laid off. So now that we've kind of gone through 2020, we're going to look at 2021, and I'll kind of try to highlight where the differences are. And then we have a nice summary slide that sort of highlights them for the differences between the two programs. So sort of looking at eligibility, similarly to 2020, a business, you know, can qualify if they were partially or totally shut down due to COVID-19 in any calendar quarter in 2021. You know, kind of as things open back up and, you know, more people start to get the vaccine and cases go down, we're not seeing as many clients impacted by this, but, you know, there are some businesses that are still very restricted in terms of what they can do to operate. That gross receipts test is, you know, if any gross receipts are less than 80% of their gross receipts in the same calendar quarter as 2019. So it's 2021 compared to 2019, and you have to have a greater than 20% drop and you're eligible. So we're seeing a lot more of our clients be eligible in 2021 because a 20% drop is a lot easier to achieve or have experienced than a 50% drop is. There is a safe harbor available for 2021 where you could elect to use the previous quarter. So kind of what this would look like for an example of what it looks like for Q1 and Q2 2021. So you could look if your Q4 2020 to Q4 2019 was down by more than 20%, you're automatically eligible for Q1 2021. Or you can look at when you get your quarterly results for 2021, it would be your Q1 2021 compared to Q1 2019. Then kind of as we move forward and we shift into now we're in Q2 of 2021, if you had, if you know you were more than 20% down in Q1 of 2021 compared to Q1 2019, you're automatically eligible for Q2 2021. So when I kind of get in later on to claiming the credit, there is ways to kind of achieve and stop making your payroll deposits up front. So if you know that you're already eligible using that safe harbor method, it can be beneficial to kind of plan more for how you're going to maximize the ERC and make sure you get benefit and kind of trigger more cash flow into your business immediately. So now in 2021, you know, bonuses and salary increases can now be included. So that's very helpful. And also there was some governmental entities that are allowed in 2021. So what this is public colleges or universities and, you know, like any organizations with the principal purpose of providing medical or hospital care. So, you know, we're kind of seeing some governmental hospitals or things like that be more eligible for the program, which is helpful for those types of entities. So what's the maximum credit allowed? So the maximum credit is equal to 70% of qualified wages, including health plan expenses, per employee up to $10,000 of wages per quarter. So for 2020, this was per year. So you can obviously see right there, it was 50% on $10,000 for the entire year, where 2021 is 70% of $10,000 per quarter. So right there, it's already a lot more beneficial just from the start. So that means, your maximum credit per employee is $7,000 per quarter. And this program originally, when it was launched, was only Q1 and Q2 of 2021. That was since expanded in the March American Rescue Plan Act. So now, you could, for all 4 quarters of 2021, so you could be looking at, $28,000 per employee if, 2021 is still rough for your business and you're still down and you still manage to qualify for all of those quarters. So we're seeing this be really powerful and some big dollar amounts that some clients are able to get depending on their employees and kind of what their wage base is. And again, kind of just keeping in mind here when you're looking to plan for this, if you did get PPP2, you can have PPP2 and ERC, but you just need to make sure that you're putting all of your wages in your buckets and you're not double claiming anything for the same dollar amount, and making sure that you keep that nice and clear and organized. That restriction for 2021, based on the 100 full-time employees, actually increases to 500 in 2021. So that's where you're seeing, that 100 employee restriction is going to capture a lot more people into it for 2021 or for 2020, where however in 2021, we move up to 500 full-time employees. And this is still based on 2019, your 30-hour per week or 130 hours in the month. So basically, if you hit that 500 full-time employees, note this is not an equivalent. So you don't have to look at everybody else. Either they work 30 hours a week and they count as a full-time employee, or they work less than that and they're excluded for this calculation. So it's really just looking at who your full-time employees are. If you have more than 500, then you can only take this credit on any health expenses or wages that were paid to not provide any services at all. So, given our market here in Western New York, we're seeing a lot more employers that fall into this 500 full-time employee category. So it's really expanding, eligibility between this and the change in that gross receipts test. So it's making it a lot more powerful. So kind of what's an example here? So this would kind of look at Q1 2021. So this is kind of an example using some employees from Lumsden. So Corey, he's a partner here at Lumsden McCormick. His compensation doesn't really count for ERC. So if he had $30,000 of compensation in Q1 of 2021, we would really only be able to use his compensation for PPP, in which we can take, because he's an owner, a max of $20,833. However, myself, if I was paid $5,000 of wages in Q1, however, maybe I got sick with COVID, I was taking care of a family member, I qualified for FFCRA for wages of $1,000. So because of that, our ERC eligible wages, if we wanted to maximize that, would be $4,000, leaving me with a credit of $2,800. If Jenna was paid, $12,000, or Matt, this is kind of a similar example, $12,000 and $20,000, if we elected to maximize ERC first and take the full amount that we're allowed per that quarter of $10,000, we're then able to claim the remaining $2,000 or $10,000 for PPP forgiveness. So all in all, you can kind of see how powerful mixing these programs can be in 2021. So this would be a possible benefit of $50,683 on only $67,000 worth of wages, between your $1,000 that you're reimbursed for FFCRA, your $32,000 or almost $33,000 of PPP forgiveness, and then your $17,000 of ERC credits. And we're kind of even having clients, that are qualifying for all of these programs or using these credit programs, kind of keeping a spreadsheet that's similar to this, that just shows, here was my total wages, here's what I took for FFCRA, if I have work opportunity tax credit, that, if I have ERC wages, this, and then here's what I have for my PPP forgiveness, just to show really obviously, if the SBA ever wanted to look at it, the IRS wanted to look at it, just so that we know we have this documentation in our file, just in case. Because one thing that was unfortunate about ERC in the American Rescue Plan Act is the statute of limitations for the ERC is 5 years instead of the typical 3-year window. So it will be open. We don't really know because this program is new, how much the IRS is going to be looking at this, but given kind of what we're seeing on our side and how many more borrowers are or taxpayers are eligible for it and the amount of credit that they're able to receive, I would guess that the IRS is probably going to be looking at this over the next few years and taking a look at these clients just to make sure that everything was done correctly. So it's really important that we establish that good documentation now. Kind of moving in here real quick. I don't want to spend a ton of time on it, but it's helpful, for when the slides are sent out, just to kind of look and see a high level, comparison. So we're looking at a benefit, 50% in 2020, 70% in 2021. The wages that we can use are $10,000 per employee per year in 2020, but $10,000 per employee per quarter in 2021. Those two kind of factors lead to our maximum credit in 2020 of $5,000 for the entire year per employee, or $7,000 per employee per quarter in 2021. For our eligibility, in 2020, we had to have that 50% drop in gross receipts compared to that same quarter in 2019, where in 2021, it's only that 20% drop in gross receipts, still compared to that same quarter in 2019, as well as including that safe harbor to use the prior quarter. And then that employee threshold for determining limited qualified wage eligibility is 100 full-time employees in 2020, but 500 full-time employees in 2021. So now we're kind of going to move into, some special issues regarding the employee retention credit, some kind of sticking points or computational difficulties that we've sort of been seeing. So one of the first things to kind of point out here is there are controlled group issues for the employee retention credit. So basically under section 52A or B or section 414 M or O, there's kind of some rules as to what you have to follow when you look at the employee retention credit. And basically this kind of captures a wide variety of people. So usually, kind of control groups is mostly an issue that we see sort of with corporations, but these aggregation rules apply to all different types of entities. So partnerships, trusts, estates, corporations, sole proprietors. Really, if you own businesses through any type of entity and you kind of have control of more than 50% across multiple entities, you could kind of have an issue when you're claiming the employee retention credit. It doesn't make you not eligible. It just means that, when you're looking at your aspects for employee retention credit, if you qualify as a controlled group, you have to look at that to look at whether there was a full or partial suspension of operations, whether there was a significant decline in gross receipts, looking at that number of full-time employees, the 100 or 500, that's done on a group basis. And also determining, the maximum credit per employee. So if you have an employee that works for multiple different entities and they all fall in the control group, you can't, claim $10,000. If, they're paid at 4 entities, you can only claim that $10,000 once. You wouldn't be able to claim $40,000 of their wages for the same quarter. And then if you have a situation like that, the credit is also going to be computed on a control group basis, which will usually align kind of with what wages that each specific entity is paying, unless you have, an employee that's working across multiple entities, then you would kind of have to allocate that out between the group. So that's kind of a big sticking point. And really, you only really have to worry about this, if you have multiple businesses with over really 50%, that's kind of where your threshold starts to have some issues with this condition. So next, so what does it mean to be partially or fully shut down for the ERC? So this is, due to government orders. So this has to be due to government orders due to COVID-19. If you are a restaurant and you get some sort of health code violation or something like that, and you're forced to shut down, that doesn't mean that you are shut down for purposes of the ERC. It really has to be due to things for the pandemic. The partial shutdown component of it, this was clarified in IRS guidance. We weren't really sure because it was just a more than nominal portion of your business, and nominal wasn't really clarified. However, it was defined eventually by IRS guidance to be more than 10%, which I actually thought was a lot more favorable than what I was expecting it to be, given especially like the 50% drop of gross receipts, that's required under that test. And then, kind of for the shutdown, as a reminder, if you're a member of an aggregated group, you have to look at it like a single employer. So we're actually seeing this, be kind of beneficial if someone owns, I don't know, say like a restaurant, that's their main portion of their business. And they also have some sort of other business that they control that maybe wasn't really impacted by the pandemic. If the restaurant makes up the vast majority of the business and has the largest piece, they can kind of pull that other business under the aggregated group rules and qualify. However, this can kind of negatively impact you if you do have a business that's maybe a smaller piece, but it's still a separate entity. But if you have to look at things on a controlled group basis and the other, maybe it was a construction company or something like that, that could still operate without really a lot of restrictions. And you had like a restaurant or something, that would be two very weird industries to be in both. But in case you were, that bigger entity might disqualify an entity that was qualified. So that aggregate group, we're kind of seeing it go, either way. It really depends on the situation, as kind of either it can pull maybe some groups in, or it can kind of push some companies outside of qualifying. If you qualify for this, you would be able to qualify for an entire quarter. If you were shut down in, for example, Q2 2020 is kind of the main quarter that we're seeing that people were really impacted by this. However, you can only take the qualified wages while you are shut down. So an example for this would be, April 1st, 2020 to May 31st, 2020, you were shut down, you couldn't open. But for June, you were able to operate unrestricted back at full capacity. You could only take ERC while you were shut down, if that's how you're claiming ERC. However, if you met the gross receipts for that quarter, all wages would be eligible. So it's important, just if you claim the ERC, especially for this partial and full shutdown, because we don't really know what the IRS is going to do, I would make sure your documentation is gathered now. It's in a file that shows, the exact dates, copies of all of those orders, very detailed descriptions as to how you were shut down, just to kind of protect your business in case anything is ever audited in the future. All right, so kind of what factors, did the IRS recommend that you look at? And so one of those is kind of your telework capabilities. Did you have adequate IT capabilities to work from a different location? Portability of the employee's work. Can the work be performed remotely? If you're a manufacturer and you work on a manufacturing line, it's obviously a lot harder to do that remotely versus me, who was an accountant. I kind of just took my laptop home, I got my monitors, and I sort of kept working business as usual, maybe with a little bit of hiccups as I got used to working from home. Kind of moving further in that, is physical workspace necessary, for employees? So if you're a manufacturer using that specific equipment, you have a lab and you need to, do specific operations like that. Obviously that physical workspace is a lot more necessary versus, like an IT company or something like that, where you can kind of do work from anywhere, depending on your work. Kind of what was the impact of transition to telework operations? I think a lot of people are like, well, I had to send all my employees home, but it's like after, a couple weeks, everybody kind of got the hang of it. You were able to get back up pretty much to normal business operations. It's going to probably be a lot harder, if the IRS ever came to look at supporting that partial shutdown, because the IRS is going to say, yeah, you might have been shut down a little bit, but you were able to kind of get back to normal. And then kind of occupancy restrictions, sort of looking at, did the restriction really limit you? If it was, you were able to kind of let everybody in as normal, or you only had a small line outside, that's really, the IRS, I think, is really going to be aggressive with this and say that you weren't really restricted based on occupancy. So kind of a great example of this is, a building like Walmart, it's able, or Target, they're able to take a lot of people. So, even if they were limited based on how many people could be in their store, if there was never really a line outside to wait to go in, even though they technically had a limited capacity, did they really, I think the IRS is going to probably be pretty aggressive with this. So just be careful, if you're taking this partial shutdown. So kind of delving some more into examples.
Are we still connected? Can you tell from your computers if we're still connected? I'm wondering if it's timed out at 9:30.
Yeah, if you're watching us on the chat, can you just chat if you can still hear us? Just on the Buffalo Club side, it looked like we might have went down a little bit. Good, so someone said they could still hear us.
Okay,
great, thank you, Richard, for letting us know. So kind of some examples, here, if you were unable to obtain materials from suppliers, so you couldn't really operate your business, that would be a qualifying example. Another one is you began teleworking, but you couldn't compute, all your operations in a similar manner. So kind of that laboratory research, manufacturing, maybe you're a physical therapy office and you could do some remote work, but then there's some stuff where you kind of can't do those procedures without having people in. Restaurants, it's a great example. It's pretty obvious. They were very limited for indoor and outdoor capacities for dining all throughout 2020 and 2021. Kind of some non-qualifying examples here. So if an essential business sort of stayed open, they were allowed to operate, but their business declined because, their customers didn't want to come due to stay-at-home orders, being afraid to go outside, anything like that, you wouldn't really qualify. And the IRS kind of has an example that basically says that right there. You have to wait to see if you qualify under the gross receipts. If you began teleworking and business kind of picked up just as usual, that would be non-qualifying. And then if you're also an essential business and you can remain open, but it's really a very small component of your business that was suspended. So an example, I like to think of this as what, Wegmans, they were able to operate as a full-blown grocery store, but maybe, their buffet bar is still closed. That's not really a huge portion of Wegmans business. So they can't really, claim this partial shutdown under that because obviously their vast majority of their business, as a grocery store, let them still operate. Obviously, this would be under that 10% rule. I would like to think that Wegmans probably doesn't get more than 10% from their meal bar, but maybe they do. I don't know. But kind of an example like that is how it would work. So another sticking point kind of relates to wages for related individuals. So if you have a lot of family members, that work for the same business that are all related to the owner of the business, there can be kind of some sticking points, and those related wages are not eligible for the employee retention credit. So there's a big long list on this slide. I know with our delays, we got a little bit late started, but you can kind of review this slide. But basically, if you've got an owner and they have family members, make sure to kind of exclude those wages. It's a pretty comprehensive list of family members that are claimed. So PPP and ERC, you can do both thanks to the Consolidated Appropriations Act in December of 2020. However, like we've said previously, you cannot double dip for ERC and PPP forgiveness. The guidance that came out for 2020 was pretty restrictive. If you had filed for PPP forgiveness, this does impact what you can claim for ERC. So originally we were kind of hoping that maybe if you just claim payroll to make it easy for your PPP forgiveness, but you did have rent, mortgage interest, all of those other qualifying expenditures, that you would be able to kind of go and say like, oh, really my wages on my PPP forgiveness were this, but I also had all of these other expenses. If they weren't on that PPP forgiveness application, it really restricts you for ERC, and you kind of have to leave those wages as is. Maybe if you had a loan of $1 million, but you put $1.5 million of eligible expenses, there's probably some wages that we could recapture from that forgiveness application. So unfortunately, the guidance was pretty restrictive for people that unfortunately filed for forgiveness before they even knew that they would be eligible for ERC. What's the tax treatment of this? So, for a lot of people, this is kind of similar to the R&D credit, if you're familiar with that. So there will be an add back to taxable income, basically through a reduction of wage expense for the amount of credit received. So basically this employee retention credit is taxable to you. So if you got an employee retention credit of $100,000, you have to reduce your wage expense by $100,000. And this is done on the same tax return that relates to the year that you're filing for the employee retention credit. So if you go back and claim it for 2020, if you haven't filed that 2020 return yet, you're going to have to modify that wage expense on the 2020 return, or you're going to have to go back and amend. And I know this has kind of been a hard point, especially for 2020 for those taxpayers that qualify for this, because a lot of the times the IRS has kind of been slow to process refunds. So they're kind of having to pick up taxable income and pay tax on money that they haven't even received yet from the IRS. So that is unfortunately a little bit frustrating. One thing to note, if you have clients that also claim the R&D credit or you claim it yourself, Wages claimed for the employer retention credit will not be able to be used for the R&D credit or the work opportunity tax credit. Kind of one planning strategy here would be to maximize health plan expenses for any employees that have R&D activity, because health plan expenses don't qualify for the R&D credit. So it's just a quick throw out there for anybody with R&D activity. And moving on. So how do I claim this? Once I determine I'm eligible, I get through all these sticking points. Basically, you report your qualified wages and your health benefits on a quarterly basis using your 941. So your Q1 2021 941 is due here in a couple weeks. So make sure you try to contact and work with your payroll provider to claim this if you already haven't. It is refundable, if your credit's larger than any employment taxes that are owed. And we've seen kind of mixed feedback from payroll providers. Some seem really willing to help their clients with this. Other people kind of are having more issues getting that payroll provider to kind of work with and claim this credit on their 941, but they should be able to help you. You can also get advanced claims of the credit. So using form 7200, or if what your employer retention credit might be, you can just elect to reduce your payroll tax deposits. So that's a great way to kind of get immediate cash flow that we're seeing some people use for 2021, is just reducing those federal deposits, and then kind of on your 941, you true up, what you did deposit or should have deposited versus what your employer retention credit is, and just kind of making sure that everything is all computed as owed. So that's sort of the quickest way, I guess, to get money and get cash flow from this program. Retroactively, the IRS guidance wasn't super favorable for this. You have to file an amended 941, and they want you to do it per quarter for the wages. We were hoping that they maybe said, just throw it on one amended 941. They didn't really do that. You have to go back if you have multiple quarters and claim it across those quarters. How long do I have to do this? So you actually have a lot of time. You have 3 years based on the statute of limitations from when the 941 was filed. And it's, the instructions say file it 90 days before the statute of limitation expires. So I think a lot of people were really worried, I got to rush and figure this out and apply for my PPP forgiveness and figure out my ERC and go back and claim everything. You have time to kind of gather your information. I would recommend, not waiting that whole couple of years of the statute of limitations, but take your time, make sure you got all your documentation and your ducks in a row, and then go ahead and submit that amended return. Just as a word of caution, don't think that you're going to get your refund for this next week. It's not going to happen. It's going to sit at the IRS, unfortunately, for a couple months, but hopefully they will get these refunds out. Right now, with, just finishing busy season and, kind of the IRS being very slow, we haven't seen a lot of these get filed and then the refunds come back yet, but it's also still very early in the process because most people went after PPP and they weren't eligible to go back and do this until just a couple months ago at the end of December there in 2020. And, it's just make sure, like I kind of mentioned before, it's important to kind of consider your PPP forgiveness application, whether you have received forgiveness, if your application was approved in full, or if the SBA maybe restricted some of it, and what wages are truly eligible for forgiveness and the ERC. All right, so that was kind of all I had. We'll check. It doesn't look like really any questions came through, but feel free to throw them probably in the Q&A will be easiest if you're joining us remotely, or if there's any questions here, we'll be happy to answer them.
Government shutdown and substantial reduction in those receipts. It seemed like they could, but
yeah.
Last time I looked at the FAQs, no one comes right out and says it.
Yeah, I mean, it's an or qualification. So I think, as long as under the quarter, you either qualify as partial shutdown or you qualify as gross receipts, you would be eligible. We kind of, I think, prefer when we can get clients to qualify under that gross receipts, just because that partial shutdown, unless you really have those executive orders in hand, we don't know what the IRS is going to do. So that could be a little bit more subjective. So as much as we can kind of qualify under gross receipts, that's a lot harder to sort of dispute.
Great. Okay, thank you so much, ladies. We really appreciate you presenting with us today. Both of their email addresses is on the screen right now too. So if there's additional questions, I'm sure Megan and Jenna would be willing to potentially answer those via email as well. Sorry about the technical difficulties. I know we've kept you late. So we'll sign off for now. We'll see you either over Zoom or in person next month. And there's a separate Zoom link for the board to join back in for the board meeting. Thanks, everybody.